In dealing with debt, the price to borrow money goes up when the Fed raises rates to bring down inflation. Greg McBride, the Senior Vice President and Chief Financial Analyst for Bankrate.com, has his eyes on the Fed and the financial fallout. Hello to you, Greg, and what's your perspective as the Fed hikes are happening? Is inflation slowing or is the economy slowing?
We are seeing some evidence that the economy is slowing, and we can expect to see more of that in the months to come. Inflation, not so much. It's still running near 40-year highs, and unfortunately, we're going to feel the pain of an economic slowdown before we really get the gain of lower inflation.
As you know, mortgage rates have been pushing above 7%. What's more likely to happen next, Greg? An 8% mortgage rate or 6% rate?
8% on mortgage rates is a real risk, particularly if inflation continues to run near current levels. We're probably not going to see 6% until we get to the point where we've seen a sustained and pretty meaningful pullback in inflation pressures. And that's something that's just not imminent.
How much more is that 7% mortgage rate costing home buyers compared to, say, a year ago?
The impact of soaring mortgage rates this year has had the same impact on buyer affordability as a 35% increase in home prices. And so tack that on to the appreciation we'd seen over the past couple of years. And you can see why millions of would-be home buyers have been pushed to the sidelines. Another way to look at this, over the past 12 months, the increase in mortgage rates means a $300,000 mortgage today costs $700 a month more than that same $300,000 loan would have cost 12 months ago.
Tell us what you're seeing with the latest Fed hikes and the effect on credit card interest rates.
The latest Fed hike will pass through pretty quickly to credit cards. You'll typically see that within 1 to 2 statement cycles. So that timing is not real great for cardholders, and particularly those with debt, because right around the time those January statements start rolling in with all the holiday purchases, they're going to be accompanied with a higher interest rate. And credit card rates are already at 30-year highs, and they're still rising.
What's your advice on credit card debt?
I can't stress this strongly enough. That credit card debt, pay it down as quickly as possible. That's getting more difficult the higher that rates go, but there are still plenty of those 0% balance transfer offers out there. Some are good for as long as 21 months. That gives you a great runway to get the debt paid off without the headwind of interest, and it also insulates you from any further increases that we see. So that's the first step in a 2-step process. The second step and most important step is you really have to put the hammer down on getting that debt paid off, but you don't want to be lugging that debt load into a higher interest rate environment. You want to put the wind at your back, grab a low rate balance transfer offer that helps you get it paid off sooner rather than later.
Let's leave on a positive note. What's happening with savings rates?
This is the good news. If you're a saver and you're shopping around, you're seeing returns on savings accounts, money markets, certificates of deposit that you haven't seen since 2008. And the returns are still rising, but you have to be looking in the right place. A lot of the bigger banks still continue to drag their feet, paying pretty stingy payouts. But online banks, smaller community banks, and credit unions really remain fertile ground for finding those higher returns. And they're continuing to leapfrog each other as interest rates go up. You can benefit. You want to send your money where it's going to be welcomed with open arms and higher returns.
Thank you, Greg, for all of your insights today.
Thank you, Angie.
Go to businessfirstam.com for where to see our show on TV.